The yield curve inversion. So this is actually really interesting, and there's a lot of noise, but there's this one thing that is a very strong signal, and money talks, BS walks. So what the yield curve is if we were to graph interest rates, meaning 10-year bonds down to 1-month bonds up to 30-year bonds. If we were to graph what that looks like, because interest rates on the shorter term, they're lower than on the longer term. That makes intuitive sense because over a longer time horizon, more weird things can happen.
Right.
Like you've probably seen this taking out a mortgage. Like a 15-year mortgage is going to have a lower APR than a 30-year mortgage.
Right.
Because over a longer time horizon, who knows? Maybe we have an alien invasion, like the Martians come and attack us. Maybe an asteroid hits, or whatever.
Yeah.
More uncertainty can happen over the long term than the short term.
Right.
So normally this yield curve, they call it a curve because it forms kind of a line of curve.
Okay.
It's sloping up.
Is it like a bell curve or?
No, it's a diagonal line.
Oh,
that
okay,
mostly goes
like
up.
a linear. Okay, yeah.
Yeah.
Cool.
It's shaped a little bit.
Yeah.
Point is, normally under normal conditions, it's more or less a diagonal line up, where the longer term portion is higher yield than the shorter portion.
Right.
When the yield curve inverts, that means there are short-term rates that actually have higher interest rates than long-term rates.
Wow.
That means something is very wrong is happening.
Agreed.
What it means is the market is pricing in more risk on the short term, than the long term. This is a very strong indication that something's about to go down. And usually when this happens too, all the experts get on TV and say, oh, this time it's not a big deal. This is when you know this is going to be a big deal because these guys are full of it. They're often talking their own books. They're trying to say this to exit their own positions. So when the yield curve inverts, this is like a no BS way that the market is telling you, hey, not only do we think something's going on, but we are actively selling our positions in this time frame to get out. Because bonds are not just magic money. Like
of course.
A bond interest rate means a bond interest rate is a function of its price and its coupon yield. So for it to have a certain rate, that means people are buying and selling to get it there.
Right.
So this means people decide to sell off this much on a short term because they're pricing in more risk there than the long term.
Wow.
That is very unusual. I know we went super technical on that.
No, I understood that.
Bear with me
that makes so much
because
sense.
this is a very no BS indicator when a recession happens.
Right.
So the number I look at, it's called the 10-2 spread, meaning take the 10-year treasury, subtract the rate from the 2-year treasury.
Okay.
When that number goes negative.
This is for bonds, 10-year bonds versus 2-year bonds?
Okay. Yeah. So when that number goes negative, meaning the 10-year is now having a lower interest rate than the 2-year, red flag. Huge red flag that probably 12 to 18 months from now, someone's gonna hit the fan.